I would like to thank everyone for taking this time to learn a little bit about the U.S. apartment market and the surrounding investment climate. I'm thinking we'll start off with a little bit of recent history, and then some to bring us to the current market cycle, and then macro level supply and demand of the apartment market, cap rates, rent and occupancy information, and then I'll move into comparing the multifamily industry with other real estate asset classes like industrial, office, and retail. Those are sort of the major classes. And then finally, we can get into some market parameters, both return and deal levels, some deal terms, and I have a recent case study of a recent transaction that we closed. So with that, we'll just jump right in, sort of where we've been and where we're going. There are about 19 million apartments in the United States today, and they're concentrated in the cities pre-war and around World War II. But in the 1960s, this asset class of garden-style apartments really started to take off, accelerating in the 1970s. And then you can see where this chart picks up. In the 1980s, had a massive construction boom, the likes of which we haven't seen, we didn't see before or since, fueled by aggressive financing from the S&Ls, and heck, there was just sort of a gold rush, which burst, right? We had the S&L crisis, sort of this bubble deflated rapidly in the mid 80s, and you can see here the decline, and then we've stayed in relative equilibrium, I'll say, until, and everybody will recall, leading up to 2008, we have economic expansion driving the vacancy rates down. You have continued building, but you had some of the lowest building here in the early 90s. You were in a recession, a real estate recession that we've seen since World War II, right? And real estate is a notoriously cyclical business. So you have a few years of this, and then animal spirits are rekindled, and banking comes back in, money flows towards the asset class, and we sort of build up again. And what's interesting is, leading up to this, the Great Recession, right, you had minimal absorption, which is this light blue line. So new people coming in and living in apartments net across the country, right, those moving out to single-family houses versus moving into apartments. You can see even one year you had negative net absorption. But we all remember what happened there, or many of us remember what happened there. You had subprime lending. You had, it was easier and cheaper to buy a home, right? I'm making my air quotation marks here when I say buy, but it was easier to get into a home than it was to get into an apartment. More money, you had to put more money down to get into an apartment. However, debt financing was readily available, and building far outstripped absorption, and you see the vacancy rate peaking in 2009, just north of 8%. Now, Lehman filed for bankruptcy in 2008. Bear Stearns was basically done in March 2008. So 2008 was sort of that watershed moment. But in construction and in multifamily, it takes about 2 years to finish a project from breaking ground to leasing up and reaching stabilization, just general rule of thumb. So what ends up happening, and your project is almost worthless unless you finish. So what happened was, even though you had negative absorption and the market was in turmoil, you completed 2 years of pretty substantial construction. So now at the same time, you have 2 years of overhang. At the same time, banks stop lending, right? They're trying to repair their capital, and the people that were, people that were living in these subprime homes started renting. People were nervous. They started coming back. The home ownership rate started its decline from peaks, and it continues to decline. I think it's sort of reached an equilibrium level now. But that sort of brings us to this current cycle, which you've seen rents really start to increase as there was minimal construction, and you see the light blue lines here representing absorption, just a huge move back into apartments. And that's driven by millennials who are starting families later. They are loath to move out into the suburbs or buy their homes. They've been staying in cities and in apartments. And you also are starting to see retirees that are empty nesters that are looking to move into closer into the downtown or into more walkable environments or smaller apartments. So that demand has really driven rents to increase, and when rents are increasing, you'll find construction not far behind. And 2017, where we are right now, is this peak blue line. So that sort of brings us to where we are. You'll see, and I'll get to this on the next slide, but after that, the market is, and you're seeing signs already that construction is tailing off dramatically for new starts. And hopefully, and the expectation is that invisible hand of the market will equilibrate. But this year, we are starting to see vacancy rates nationally increase, and as this new supply of construction of new product is delivered. And what that what you would expect from those supply and demand, from the supply and demand activity on the last slide is just outlined here without all the other noise in the other slide. Right here, we have a little dip, but you're generally seeing rents go up. I mean, it's almost a 20% increase, just north of a 20% increase nationally in apartment rents at the same time that occupancy has declined. And I would say sort of a rule of thumb is once you get south of a 5% vacancy rate, you're going to have rent pressure. There's just not enough inventory, and it's the landlords will have, they'll have more than enough renters. They'll be able to replace the normal turnover, and rents will increase. And we're below that, so you would expect rents to go up, and it starts to, again, equilibrate around 5.5, which has been sort of a longer-term national average. Cash flow. So in the meantime, cash flow has been getting more expensive. And what does that mean? It means that for $1 of cash flow generated by an apartment or a real estate asset, right? It's the multiple. How much will you pay for that cash flow? And what's interesting in this slide to me is, yes, cash flow has gotten more expensive. The scale here is not that great, so the trend is mild. But a cap rate in 2004 of almost 7.5, 7.4, is now sub 6, 5.5%. So you have a pretty solid trend down. But what's interesting is that the spread between cap rates and the treasury rate is pretty stable, and if anything is wider now than it's been in a long time. And you can see it's a little bit anomalous, at least in this time frame, in the frothy days pre-Great Recession, right, when you had all of these financial instruments, people chasing subprime and all aspects of bonds and commercial mortgage real estate up and down the risk stack, there's not that much of a spread between the 10-year Treasury and cap rates. So maybe now there is room for cap rates to compress if Treasuries go up, but I sort of think you have some room to absorb an increase in Treasuries without prices moving. Time will tell. What's also interesting is just recently this little end of the Treasury chart, that's since come back. I think we're at 214 yesterday. I didn't check today, so I apologize. But it seems like we have a pretty consistent spread. So maybe there's upside. But again, that's something that I would keep in my back pocket. I would think about that. But we also, cap rates trend, they're correlated highly with interest rates. So your rate outlook is going to have a huge impact on the price of real estate. Let's see, what do I have here? Now I want to talk, so that gives a little bit of a background just on macro vacancy, occupancy, pricing, and cap rates. Another interesting thing is, and a little bit about my background, I worked as Rahil said, in the debt markets for 12 years. And so I financed all asset classes, invested in all asset classes. At Stonecutter, I've worked on industrial and retail. We've owned industrial and retail assets and continue to look at them. But we started doing multifamily because it seemed like a more attractive risk profile and return profile. And this is another way of looking at this previous slide, right? This is the spread between the 10-year Treasury and cap rates. This shows that spread, which is relatively constant, but it breaks out the spread by apartment, office, and retail. And it highlights that the spread to Treasuries for apartments is lower than office and retail. And it doesn't have industrial in there. Industrial is a little bit smaller asset class. I would imagine that industrial is probably, I would imagine it's in between apartment and office, probably close to the office line. But apartment is a favorite asset class, and we'll get into this a little later, but why is that? There's more, first off, people have to live somewhere. Even if they're unemployed, you may get a decline in household formation, right? You may have people move in with one another. People may stay at home longer. People tend to put off getting a divorce in down markets when they're feeling flush. People end up getting divorced sort of nationally. It's sort of interesting. I never realized that until a few years ago. But people have to live somewhere. Office, you're seeing a rise in telecommuting, right? That's a theme that comes up. But also just changing tastes. And retail, it's pretty obvious, what the pressure is there with e-commerce. But also there's additional financing sources that are only available to multifamily, and that is, the agency Fannie Mae and Freddie Mac sort of have these government-sponsored and now sort of owned entities, which their mandate is single-family home ownership, but they also have massive multifamily portfolios, loan portfolios, and they lend at cheaper rates. So you have this subsidy to multifamily landlords, and it manifests itself in a higher price relative to other assets. So that's this delta for the same dollar of cash flow. Within multifamily markets, I want to say a few words. Right. So far, we've been speaking about the market, right, on a national basis, but the old adage, is, real estate is local. This isn't even local. This is just to show a little bit of a regional differentiation. You can have a massive difference from block to block. So that's the old adage, and it's absolutely true. But there are some regional trends. And I would also say that within the multifamily market, there are a couple of different tiers, right? You have your major gateway markets highlighted here: San Francisco, New York City. I would add Washington D.C., Chicago, Los Angeles, and there are some other smaller cities, but that I would put in that category, like Boston and maybe Seattle, where you just have really high rents. You have institutional investors, and they have the deepest capital markets. They have the deepest investor base, and they're the most liquid. So therefore, they achieve the lowest cap rates. And these again are just approximate here. Then there's the secondary markets, which they still attract institutional capital, but it becomes it depends on where you are in the cycle. So institutional capital is not always interested in Phoenix, Charlotte, Tampa. Dallas is actually probably an institutional market now, but Houston I would put in that secondary, and that's one of the few markets that has a little bit more distress now. There's not much distress in the country. And then you'll get institutional money, and they're deep, but it's not like a gateway city. So there's a little hit to the cap rate. And then there's these, I would call it a tertiary market. I highlight here Jacksonville. There's levels below that, of course, but much of the Midwest, I think in these secondary and tertiary cities, you're not going to get major pension funds or sovereign wealth funds coming in and buying there. At least not, I haven't seen that. But you will get larger opportunity funds, and you'll get individual investors. But across the board, investor demand remains strong. We're seeing there are tailwinds in all of these cities, from the home ownership rate. I already touched on debt markets, and cap rates have been declining. But here I also want to go into, I think the next one's cap rates by region. So this one's sort of interesting to me, right? The black line here is the United States in general, right? The Northeast has seen the biggest in cap rates, the largest increase in value since 2012. And 2012 is really when transactions started, the transaction volume started picking up in this latest cycle, right? Volumes, everything went ground to a halt in 2009. And you would have been a genius if you purchased in 2009. Everybody talks or knows somebody who did a deal. But the truth of the matter is, not much changed hands. And as a volume data for those years, it was pretty minuscule. Mostly it was banks trying to figure out what they could do, and getting back the collateral, and owners trying to hang on. But in 2012, deals started, the log jam broke and deals started occurring. Since that time, the Northeast, which is driven by New York, right, and Boston, right, those cap rates have declined dramatically. Another thing that's interesting to me is the Southwest is pretty much where it was, and I think that is really reflective of Houston. Right now, in the market, there is a quest for yield. It's difficult to find yield everywhere. I think that is one of the major attractions to real estate investing is the current cash flow. And you can find that in some stable markets, Midwest stable markets. They're not really growing that much. So you can get a higher yield because you don't expect growth from the underlying population. but I focused on the Southeast. To me, it's the most interesting. Well, the Sun Belt. I like the Southwest as well, like Phoenix. But I'm in the Southeast because you have tailwinds, population growth, you have job growth, people moving down there, escaping the expensive lifestyle, cost of living in New York. You have that same phenomenon in the Southwest with people escaping, San Diego, LA, those types of prices, and businesses escaping that and the regulation and moving to Florida, Texas to be sure, and the Southeast. So we've been focused there, and you're getting tailwinds as well, and you're seeing more institutional money coming in. So now I want to compare apartments to other real estate. And we touched on a few of these things along the way. And I'll keep it to the major food groups, the multifamily, office, retail, and industrial. And you can see, and these are, again, general, and you can subdivide any of these. So, don't hold me to task. Say, there's always pockets and of office that are far better than this and more attractive. But generally speaking, I think, multifamily has the lowest vacancy rate. You're seeing a bifurcation in the office market between downtown, a tech office that's modern, and suburban office, which is generally suffering. Retail, you have the community centers, which we all go to. We're still buying food and groceries, although starting to go online. But there's a lot more entertainment-oriented retail, restaurants, lifestyle centers where you're going not just to pick up sundries, but you want to go and entertain your kids and have dinner with your wife or do whatever it is. There's a real bifurcation that is being chased by everyone. Amazon is killing the regional mall and some of these old power centers, like the Best Buy and Dick's Sports, that type of anchored retail. Industrial holds up nicely. You see a high vacancy rate because they're cheap to put up. You can tilt up 4 walls, add a roof, and you can build 1 million square feet. But I would bet if you break this down and look at major transportation hubs and storage and logistics nodes, it's much lower. And I think that industrial, it's got an attractive future because it actually benefits from the move in retail to online. Typical lease terms in multifamily, 1-year leases. You'll have a few that are shorter. Maybe you do a 2-year lease. You can manipulate your rent roll. So, you figure you're going to have about 8% of your rent of your tenants that are renewing every single month. So it's manageable. No single tenant has much power. This is one of the main things that attracted me to multifamily. And I'll digress for a second. A quick story: when I was a banker, and in 2008-9, we were working with our landlords, and I can't tell you how many times I heard the story where the landlord had a couple of tenants, right? They're strong credits. They own 1 or 2, 3 centers. They're not Simon or, a major REIT or major national player. They thought they were in good shape. The landlord thought they were in good shape because they had 7 years remaining on the lease or 5 years remaining on a lease. But what happened was there was distress in the market, and the tenant calls up, the major tenant, and says, you know what, my sales aren't there. I'm not doing well. You have to discount my rent, or I'm just going to shut down the store. The tenant has the default option. And they'll keep paying the rent, but there's all these other, it's called a co-tenancy agreement, where if one major tenant leaves the store, all the other tenants can leave, can stop paying rent or stop operating. And the bottom line is, we would have landlords coming back and asking for relief on their loan because they had to renegotiate the leases or else they would lose everything. And it struck me that in good times, you can't go back to the tenant and say, you know, your sales are killing it, so I think you should pay more in rent, right? No, they have a 10-year lease. But in the down times, the tenant can shut the doors and you have to renegotiate. And I saw that time and again, and it really stuck with me. I saw that in office, and I saw it in retail. And multifamily, to be sure, there was pain, but when you have hundreds of tenants, there's not a single tenant that has any leverage, and they're granular. And it's really one of the only asset classes where that's true across the board. Student housing is a little different, obviously, because you have one major driver. But I'll stay away from the specifics and keep it pretty general. We touched on the financing sources, but multifamily is the only one, and I have another slide. Here we go. Multifamily is the only asset class in this green line. So everything below this green line is multifamily, and they're a pretty decent percentage of all the rest. And this hockey stick in the banks, that's pretty much all multifamily construction. So that's going to come back down. And I'll get to that. I'm getting ahead of myself. But multifamilies have better financing, and there's more liquidity. So even when the commercial real estate market seized in 2009, life companies remain because they're lenders for different reasons. They're not they're matching their assets with liabilities, right? They're in their life life insurance or claims business. But CMBS went from $240 billion a year in issuance in 2008 to zero in 2010. 2009 it was like $30 billion, which was left over from 2008. So people don't really talk about that, but it evaporated. The GSEs, they were there, and it kept the lights on, and it kept transactions moving. And that's one of the reasons why you see the lower cap rate. Talked about desirability, investor concerns. I will touch the new supply in multifamily. That is the concern, right? You're seeing, back on that first slide, the spike in deliveries coming this year. But I can transition to here. That's coming from this lending. And I can tell you that I'm already seeing the invisible hand and maybe the visible hand working. The Fed has put calls into a couple of the big banks telling them to lower their exposure to multifamily, and they're doing that through construction because it's non-cash flowing. So you've seen in the last 3 quarters decline in construction starts. And going back to that first slide, I think in a year, the leverage has come down, and you're going to be back in a more equilibrated state, which to me bodes well for the market. We'll see some softness at the high end for the next year or two. But personally, I'm looking at putting in more money, equity, so that I can get the loan, because only the stronger sponsors are going to get quality loans, and if they can get it at all. And I'm looking at delivering in 2-3 years. So now here we can move to, jumped ahead. Typical multifamily, and I'll pick up the pace here for the end, and because I know we're going to run short on time, and again, I appreciate everybody coming at this hour. Multifamily return profiles. There's the core, which are those gateway cities, Class A assets in Class A cities, or even those B cities. They're going to see cap rates in the 3s and the 4s. Core plus, that would be A properties in the lower tier cities, or sort of these B properties in solid cities, or assets that need work, a little bit of work, but they're pretty new. You want to own them. And then there's value add. That's the smallest part of the market, because it requires, you're not just a financial buyer. You have to actually do work and have a capital plan, an improvement plan, and a management company. And everybody will tell a story about value add, but the true value add, there's fewer of those, and it probably represents 10, 15, maybe 20% of the market. And you see here corresponding unlevered returns. I use year 3 because that's where you get the pop from value add, right? You do the work. Hopefully your rents increase because you've improved the property or mitigated the issues, and then you see the benefit. Year 1 leverage returns. That's really what you get after you put the loan on. So you can see here at core, there's almost no positive leverage, right? You put on the loan and your cash flow, the interest rate is roughly the same as the cash you're getting. So there's not that much, but you know what? That cash flow will be durable and you can hold it for forever. And hopefully you'll get those types of returns. And you get a long-term appreciation. Value add, you're taking more risk. You should see the higher returns. And in the market today, I'm seeing IRR targets that I outlined here. As far as deal attributes, anything goes, right? I had a tough time putting this down because in a private real estate deal, it's negotiated. And when you get into the value add space, I've seen deals run the gamut, right? So it's run the gamut. So I would say you want to focus on quality sponsorship and alignment of interest. So like to know, I've invested with folks before I started Stonecutter, and it goes from paying a disproportionate share of profits, a reasonable share of profits after the investors have gotten their money back with the preferred return, to paying the majority of the cash flow to the sponsor. And there's also different underwriting, quality of underwriting. There are different upfront fees, and it does run the gamut. So my view was, let's show the alignment with investors, right? I like to see that in my partners and people that I've invested with. I want to do well when the people I'm with do well. And I think a win-win, right? It makes for a good situation. And then last slide here, and then we can get into questions. It's just a representative deal. It's a recent deal that we closed, and it highlights some of the things that we've touched on here. It's a value add deal. We purchased this we'll call this a tertiary market, right? Greensboro, North Carolina. You're not going to get major institutions that are coming in there, but they're value add investors and local investors, cash flow oriented investors. We're spending 10%, 12% on renovations. What are those renovations? Well, we're going to improve the landscaping. We'll paint the exterior. In this case, change the windows. There was some roof work. That helps, but really where you get your money is we renovate the interiors and you improve the common areas so that someone, right, and the tenants appreciate this. They want to see, they can't afford the new stuff, right, but they want a new fitness center. They want to go to the pool and have it look good. They want to bring their friends. They want to be safe. They want to park their car and walk up to their home and be proud and enjoy, their living area. And there's new stuff like the new wood look floors and new lighting fixtures. And you do these changes. And what we project is that you're going to see an increase in rents. Right, so going from a purchase price cap rate of 6.7%. When we finish the renovations and increase the rents, just about an 8% unlevered yield on on our total cost. And when you leverage that, you would end up with an 18% IRR, mid-teens IRR after a 5-year hold. And this, I think, from what I've seen, it's representative of the deals we do. We've financed it with Freddie Mac, so the GSAs pointed that out. They're active, and they've been our go-to lender for the last year, and they're active. They're always active, but in the last year they've been particularly attractive. And the other thing, and this is, I started with cash flow being the driving factor, the search for yield, and I'll end with that before we open it up to questions. But the year one cash on cash return is budgeted to be 10%. And I will say that across our portfolio, and on all these deals, it's one of our acquisition criteria. And what you should expect to see if you're targeting sort of this mid-teens return is cash flow coming in. And if there's no cash flow, you should be compensated more, right? You should have a higher return. And there are reasons why you do that. And of course, construction has no cash flow. So they should be higher yielding deals. And we'll see. We'll see how it turns out going forward. I think that we're in for we're going to have a couple of interesting years on the new construction front. And then the market will hopefully, and we're seeing signs of it, equilibrate until the next change, because it's always evolving. So hopefully that helps, gives you some context and an overview of the multifamily market, and it shows some differences between multifamily and the other major asset classes. And obviously, whenever there's a deal, you got to look at the specifics, because I can talk all I want about national cap rates, but there's a story, and I like to know about the story and the reason why a single asset is doing poorly and why it can be better. Hopefully I wasn't on mute that entire time.
No, you weren't. Thank you, Rob. Thank you so much. This is very helpful. We do have some audience questions that have filtered in over the chat line, so let me kick them off to you. Firstly, can you give us a sense for the actual returns your investors have historically seen in their investments, cash versus total returns?
Well, we like to target, I'd say, mid-teens, like this deal that's on the screen now. That was our most recent deal, and that has we have started on most every deal at 8%, right? So an 8 to 10% in year one. We're targeting sort of mid-teens. I would say that 2-3 years ago it was probably high teens, right? So it's come down a little bit. But we also lowered our leverage a little bit. And let's just, for round numbers, right, if it's a 5-year hold and you're projecting a 20 IRR and you're starting off at 10%, you're roughly 50% cash flow and 50% residual.
Okay.
And what doesn't show up here, and why I personally have focused on value add investing, and it depends on what your goal is and what your time horizon is, but you can refinance, right? So you and return some of your money if you're successful, right, in improving the operating income. So what we've been able to do, and we have a series where investors are at 20% already through a refinancing, but we still own the asset, and we're distributing at a lower amount, right, on the initial investment, but you get all your money back. So those deals, they've outperformed, and to be sure, we had tailwinds, but we're trying to show what we think is achievable and realistic, and it's more aggressive now than it was, the market in general. Yields are about the same, but the price per unit is a little higher because rents are higher.
Okay. So we have another question. What are the key variables that can negatively impact your assumptions that go into calculating your exit NOIs and cap rates? Specifically, after renovations, you clearly need to increase rates, but do you have instances where you've not been able to increase your rent rates?
Well, I'll start with the back end of that question. We have not had instances, but that's certainly possible. In new construction, you have to finish before your project is valuable. So you have to spend all the money. In a rehab, you don't have to complete the rehab. So you can stop, right? We've raised this money. We have this money set aside, $2.5 million. If we start spending that, and you're going to see right away where your new leases are, and you're not getting a return, just don't spend the money. That hasn't happened, but that is one of the variables that we watch like a hawk. But the biggest variable that would alter your return profile is interest rates, right? Like if rates go up, we saw before cap rates are correlated, highly correlated with interest rates. Rates go up, you're probably going to have a higher cap rate. Your value will go down. But what else is happening? Why are interest rates going up? It tends to be because we're seeing more robust economic activity, and you're generally in an increasing rental rate environment. It is possible, of course, right, that you have inflation or you have increasing interest rates, but your rents are stagnant, and that would be a bad outcome.
Okay.
That has the biggest impact.
So, you talked about interest rates. That's actually a good segue into the next question, which is, given the compression in the multifamily housing cap rates in the 4 to 5% range, how have the cap rates held up in some of the other sectors of commercial real estate, say, for instance, student housing or hotel properties? And which of the sectors of commercial real estate have had cap rates that have held up well? Do you have any view on that?
Well, cap rates across all of these asset classes are going to be correlated with treasuries. So you've seen cap rates come in. Now, there are some sectors that cap rates have not held up well, like B malls, right? Secondary retail, suburban office. It's horrible. You can't sell a full office building because there's no value to be added, and nobody believes that the cash flow is durable. Student housing has been very strong. It's very attractive, and we've seen those come in to the point where I have not ventured into that space. I've done some apartment deals that are in student towns but are not purpose-built student housing. It's a different business. There's operating risk, and you lease one, there's a major leasing season that if you miss, you're sort of in trouble for the year. But if you make it, you're going to be fine. So hopefully that answers the question. But I think that you're seeing generally, I'm going back here, cap rates by region. Here, cap rate spreads. See, they move similarly, but they just overall, right? Multifamily has been better than office, which has been better than retail, and there have been movements over the years.
Okay. Thanks. So, Rob, there are many funds that are focused on multifamily assets, clearly. What operational or investment thesis do you have as a fund that you think truly helps you and your fund set apart from others?
I think there's two things there, right? Well, three. One, I'm not a fund. So I don't have to buy, right? A fund raises the money. The fund has already made all their money the day they close the fund, right? And then there's nothing but upside. They have to spend the money. So there's an incentive for them to just spend it. I, on the other hand, right, if I don't do anything, I'll be fine. If we see a deal, my partner and I, we invest in it, and then we show to our investors. So I think that's a big differentiator, and people see what they're investing in as opposed to leaving it to us and hoping that we pick the right ones. People look at it and say, I like this, I don't like it. They can have their own opinion, ask questions, and the money is invested right away, rather than being called over a time period. As far as differentiators in which type of assets, we touched on it before, and there's nothing wrong with buying the core plus deals, longer term holds, and that's the majority of the market. But there's not just definitionally as much value add there. We want to do work on deals. I want to find assets that have a story, that have been mismanaged. Real estate is granular, so even in a highly competitive market, there's always someone who needs to sell, some reason why you can get a good deal relative to other deals. And if you're not looking to just be the biggest guy on the block, you can find and wait for those opportunities. And that leads me to the last one, which is we set out to invest in less competitive space within the market. And I also look at non-multifamily deals, so you always know, hey, am I chasing, or is there something better out there? And we look for the best overall deal. But we're in a smaller space where we may be competing with individual owners, smaller funds, local operators, right? But we can bring sort of more an institutional mindset, institutionalized capital, right, to a sub-institutional space. And what's that? It's smaller. The big funds, the Lone Star, Apollo, or BlackRock, they can invest in a $20 million deal. It's just too small for them, and we're lean, right? Like they can't spend $6 million of equity. They have to put out $3 billion in the year. So there's less competition. I think you can find deals. There are more unsophisticated operators, and that's what we're targeting. That's how we try and differentiate ourselves. And on the back end, it's through quality reporting and just telling it like it is, warts and all. Nothing goes perfectly according to plan, and I like to you tell the truth, the whole truth, and nothing but the truth. Everyone I know is in it, including
always a good policy. So,
Yep.
So time for one last question, Rob. I mean, and you touched on this a little bit in one of your slides, but given your experience and the deals you're seeing today, how do you see the multifamily space evolve in the coming years? You talked about compression in the market. You talked about availability going down, but what is your overall macro sense of where the opportunities lie?
Well, that's the $1 million question. What's next, right? I think that we're seeing homeownership rates decline. I think that there's a movement we're starting to see the beginning of this, of baby boomers that move into their houses. There's a delay in moving to those same homes by the millennials. Even though they're starting to have kids, they're doing it later, and they are trying to have kids in the apartments. So I think that will remain attractive, that the B apartment space will remain attractive for a longer period of time. Also, there's nowhere for people to go. The national occupancy rate is 95%, right? So that's a strong level. And you're seeing a lot of this new construction. It's occurring on the sites where older properties were. So while you're adding high end, the B apartment stock is not expanding dramatically, and that's what people can afford. So now, and then there's another, it's what's attractive to capital, what's going to drive, capital drives also prices, and you're seeing a move from new construction and luxury because of that spike on that first slide, right, of new construction deliveries coming this year. You're seeing a move into the B space. So we've been selling a lot of assets. We'll see what happens, but I think that you're going to resume the upward trend in rental rates in the luxury space. And I think they'll slow, but they'll continue going up in the B space. But I think you've got a year, 18 months, maybe 2 years in the luxury space until all of that supply has been absorbed and you just have lower starts. There's going to be fewer deliveries 2 years from now. So I'm trying to position myself to take advantage of what I see as an opportunity 2 years out in luxury. And right now, continue looking for those diamonds in the rough, the special stories, because demand will continue to be robust for the B space. But in the last 6 months, call it, you're seeing a lot of interest in that sector from people who 2 years ago wouldn't really have purchased these assets. They're gaining traction as a institutional asset class, the older apartments. And I call older pre-2000.
Okay. So we do have one more question. Since you purchase properties around the country, do you manage your properties yourself, or do you outsource these to different property management companies?
In the market, there are people who do it both ways, right? And you see the vertically integrated management owner. REITs are that. We partner with local management companies, and that's just how we've decided to build our company. And those partners have come through long-term relationships, personally and banking, and referrals from long-term relationships. But I like the idea of having the on-the-ground local owner, right, who knows the local, he knows street by street. They've invested in the properties, but then also, right, I think it frees me up to make the right decision for the investors, for myself, and for the asset, right, without regard to, hey, I have to maintain this infrastructure, so let's not sell, because if I sell these last few assets, I'm going to be out of the market. I can move between in and out of markets, and I'll see the relative value between Phoenix, Charlotte, Tampa, New York. Right? We built a condominium in New York. We did one deal. We thought we were going to do more. Prices skyrocketed. That deal did really well. I can't find anything else that makes any sense. We've done a lot more in Florida. We purchased a lot in Phoenix. Those have gone up. It's been very difficult to find something. If I had a management company that I owned and they were focused completely in Phoenix, you may end up leaning into it a little bit more than you would otherwise.
Okay.
Long-winded way of saying my partner.
Okay. So that about wraps it up, Rob. Thank you once again for agreeing to do this talk and share your insights with our Smiley Chamber members today. Everyone, a recording of this call will be available on the AICC website in the coming days. Rob, any last words? Well, I appreciate everyone who's still there, and even those who aren't. And hopefully I didn't put you all to sleep. Thank you. Thank you very much. And thanks, everyone, and Yalimadat. Thank you.